Welcome to our Lunch with Don today. And where we simply answer questions. And we go through whatever really is kind of on your mind or whatever you brought to the table. And we invite, over this next half hour, we invite whatever questions you have about estate planning, about income tax reduction, about lawsuit protection, about entity structuring, those types of things, and we welcome those. Until we get any questions, and Kendall, I don't know, as soon as you see something, let me know. Let me tell you kind of what's been on our mind, my mind, as you know, we run an asset protection hotline. The questions that have come in have mainly revolved around income taxes. And what are some of the last minute things that we can do? And so I usually go through a list of a checklist of what people are doing. That there's about a dozen tax returns I prepare every year, and I'll sit down with my niece and or my nephew or my kids and go, okay, tell me about the businesses you have. That obviously the very best way to reduce our taxes is to have a business of some kind. And this isn't a wink, wink, yeah, I sort of have a business. You do have to have the intent to make a profit. And one of the best ways to determine that you have a intent to make a profit, these days almost every business needs some type of a website, or you need to do some advertising of some kind. Business card, just have a simple business card. I'm going out. I'm trying to, for instance, I do a little custom leather work for people. I finished this last night. So I have a business. I have the intent to make a profit. And so I created a little, I did the tooling and I did. So now I have the intent to make a profit. I have a business motive. Do I make money? Well, no. Well, yes, on some years I absolutely do. There's other things that we do that with the intent to make a profit. So we can with a business motive, then we need to substantiate that we really are trying to make a profit. And advertising is a very, very critical way. Did you have a website? Did you have a business card? Were you actively doing something to try to promote your business? Or is this really just a hobby for you? And so I think that that's kind of a standard that the IRS would look for. But if we don't have a business, you're very limited to what you can deduct. There are some things, but you remember when they raised the standard business deduction and went from $12,000 to $24,000 for a married couple, or from 6 to 12 for an individual. And what that means is here's the money that I made, and now they're going to give you a standard deduction. Let's say you're a married couple, $24,000. Well, now I can't itemize. Well, you could, but it may not be worth it. And you might save a lot more money on taxes just taking the standard deduction. Well, I don't have enough in mortgage interest and property taxes and charitable donations. Those tend to be the three big ones. To warrant, well, that's good because now the standard deduction covers it. So what we could do is maybe group our property taxes and prepay them, prepay our charitable donations, or group them. I don't have enough this year, but let's wait to gift to charity next year. Make sure that even if you're a sole proprietorship, the things that I see are most often missed. Mileage logs. People go, well, it's only 56, 57 cents a mile. Those miles add up really quickly. So mileage log for anything business related. Paying your children, medical, even a sole proprietorship. Whatever you're paying in medical premiums, you can deduct as a sole proprietorship. Make sure you're funding your IRA accounts and your HSA plans. Those are critical things that a lot of people miss. In fact, almost everyone that's come to me for taxes this year, I didn't know I could deduct what I'm paying for medical premiums. A lot of people are W-2 employees, but the employer is only paying half or a portion of your medical premiums. But as a self-employed person, now you can deduct whatever's left. Home office deduction is a huge one, that if we can just say this area right here is exclusively used for business, now I can write off that portion of the home, even if it's only 2 or 5 or 10%, but it's 2 or 4 or 5% of my mortgage, my rent, my utilities, anything to do with this property. I can now write off a portion of that if, again, it's exclusively used for business. So don't underestimate those things. Your office supplies. Don't underestimate that. Office equipment. Your cell phone. If your cell phone is required for your business, and frankly, I don't know any businesses that don't require a cell phone anymore, or your internet. If those things are required for a business, and again, I don't know any business in America that doesn't require cell phone or internet, then the IRS says you can deduct those 100% without the need for record keeping. So look at those types of things. Look at for whatever you can deduct. And again, we're not trying to change your lifestyle. What we're trying to do is make things, move the personal expenses, move them over to the business side if we can legitimately say this is a business expense. Look at vacations, and at least in the future, and how can we call this a business meeting? And don't push the line too much, but look for attractive ways to make business and combine that with travel. Look for ways to pay your children. Remember, children don't pay taxes up to $12,600, or at least federal income taxes, and most state income taxes either. There might be self-employment taxes. There's some ninja ways to get around that, but those are some ideas, maybe last-minute tax tips that you could do. Look at the educational expenses that you've had. And if they were educational for your business, don't try to write them off as education. Look to maybe research and development. I'm researching ideas to make money for my business. Remember, all business expenses need to follow the acronym CORN. It needs to be customary for your business. It needs to be ordinary for your business. It needs to be reasonable, a reasonable expense, and it needs to be necessary for the business. Somebody called in the other day and was asking, well, then can I write off a business trip to Hawaii? And I said, well, what's your business, and is it making money, and is it reasonable that you needed to go to Hawaii to have a business meeting? If a business is making lots of money and you really need, the board of directors just needs some time away, then maybe a cruise, maybe there's things taught in Hawaii. Maybe there's a reason to look at real estate in Hawaii. Maybe there's something that's going to be taught on a cruise ship that's not going to be taught anywhere else. That would be a legitimate reason to have a board meeting, but just to go to Hawaii and call it a business trip, it needs to, again, needs to be customary for your business, ordinary, reasonable, and necessary. I hope that makes sense. Kendall, how are we doing on questions? Are we getting anything from our people yet?
Well, so far, a lot of people saying, have a good day, Don. We're excited to hear from you.
Good.
So, yeah, a lot of good comments saying they're loving the tips.
Okay.
So, any more tips? I think, especially tax time, it's coming up.
Well, that is the big thing, and especially with people really nervous about taxes. We're already, most of us feel like we're being taxed too much as it is. and we're looking for ways to reduce our taxes. But with the threat that the new administration has had to raise capital gains taxes, to you know what, that's actually not a bad idea, is to spend a minute on capital gains taxes. And look at some ways to reduce that. If you're buying and selling in the stock market, if you're buying and selling in real estate, those principally are where most capital gains are taking place. We look at buying and selling as much as possible within IRA accounts, whether it's a Roth or whether it's traditional, whether it's an IRA or a 401k. They're all tax-free environments, meaning that they grow generally without paying capital gains taxes. And so those are great vehicles. Whenever we can move our trading account or have a trading account in our IRAs, or we use our IRA to invest in real estate, if we're flipping, that would be a really good place to have it. And people ask me all the time about a Roth conversion. Is this the year to do a Roth conversion? And I would say if there's ever going to be a good time, now might be the time. But a Roth conversion, keep in mind that it's not an all or nothing proposition. It might be, let's say I've got $250,000 in my retirement accounts, and I want to convert that to a Roth. Well, if you converted all $250,000, that would be treated as ordinary income to you, and you'd be paying some big taxes on it. So look at the things that are going to appreciate the fastest. If you've got really slow moving, you got some CDs that are making 2 or 3%, the break even point where if I pay the taxes now, what's the break even point? The break even point on a slow moving stock is going to be long way out there. It may never be worth it for you to pay the taxes on that. Continue to treat that as a traditional IRA and don't convert it. But if you've got something that's appreciating at maybe 30-40%, you're in the stock market, you're growing, that would be a good thing to do. If you're expecting a high rate of return on an investment, maybe 20-30%, that might be really, and depending on your age, of course, if you've got time to make that conversion last and have that break-even point, happen in your lifetime, and before you start withdrawing the funds, then now is a really good year, because I believe capital gains are certainly going to go up, and I think taxes are certainly going to go up, and we'll start to see that next year. So whenever we can do those Roth conversions, it's probably something to look at. But look at the critical thing for me is the timing of the transfer, and this year's a good time. And look at the rate of return you're expecting. Take the things that are appreciating the very, very fastest, and those are the assets that I would convert soonest to a Roth IRA. Another way to avoid capital gains taxes is your personal residence exemption. And whenever you're selling your personal residence, remember, as long as you've lived in the house for 2 years, there's 2 standards. It has to be in your name, so not in the name of an LLC. A trust is okay because that's a disregarded entity. A single member LLC that's disregarded, that's okay because that's also disregarded for tax purposes. So the IRS looks past that and says, oh, you really own the asset. Okay, that's okay. But if we put something in, let's say we put our home in a limited partnership or a multi-member LLC that's treated as a partnership, or we have a corporation. Well, you don't own the asset, the corporation does. The LLC, the limited partnership, does. So the 2 standards, it has to be in your name somewhere with 2 of the last 5 years. And it doesn't have to be concurrent. It doesn't have to be consecutive. Somewhere between the last, and they will look at the exact days, if they have to determine whether you met the standard. 2 of the last 5 years, and it has to be in your name. Then you're exempt for capital gains. Up to $250,000 if you're single, up to $500,000 if you're married. Now, this exemption is also on the table, and so, if you're interested in politics and what the Biden administration is trying to eliminate, that's one of the things that they're trying to eliminate is that capital gain exclusion for high income earners. And so look at that, but use that whenever we can. Upstream planning is maybe a third way to reduce our capital gains taxes. Let's say I've got a piece of property. You could gift that. You remember there's a gift, you can gift up to $1 million. Maybe I gifted that to my parents with the stipulation that I get that back. So I've got a huge capital gain. I'm getting ready to sell it, but I don't want to pay the capital gains taxes. I gift that to my parents and let them. They inherit my basis in the property, but when they die, right now with the capital gain goes away. You receive a step up in basis. And so gifting to parents maybe that are not doing well, as long as you get it back, it doesn't go to your other siblings, is a great way to reduce our capital gains taxes. 1031 exchanges are a great way to reduce taxes. And remember, there's a 1034 exchange for life insurance, and that's going to be working the same way. Charitable remainder trusts, family foundations, and then something that came to our attention this week, ETFs. Rather than buying mutual funds, when you buy a mutual fund, and maybe it's selling General Electric stock and it's buying IBM stock, which is now buying Home Depot stock, and as the mutual funds buy and sell, there's capital gains taxes that are incurred to you. Well, if I don't have my trading account in an IRA, those capital gains taxes will be paid directly from me. Remember, if we've held that for shorter than a year or shorter, those are short-term capital gains, and you get reduced rates for long-term capital gains, but they're still capital gains. If instead of buying mutual funds, we're buying traded funds, ETFs, then those capital gains go away. We don't have those because you're buying a whole sector of stocks, not individual stocks that aren't subject to self-employment or capital gains taxes. So there's 8 different ways that maybe little free ways that you ought to be looking at to avoid capital gains taxes. Look at those things, but the biggest questions that we've had, or that I've had personally over the hotline for the last week or so, have all been about income taxes. Oh my gosh, do your best. If you haven't filed your taxes, or even if you have and you need to go back and amend it, look at those things. Especially, you look at insurance, look at medical, look at whatever you're paying in whatever we can pay our kids. Look at. Could we call this a business? Was this really used for business? And if the answer is yes, did I buy this cell phone? I can't run my business without it. Let's write it off as a business expense. Any questions, Kendall, from our
so Marie
people?
asks, you mentioned about deducting medical insurance premiums. So she
Correct.
said she missed it on her taxes already filed this year.
Okay.
So you can go back and amend, right? But
Right.
So she's asking, can her sole proprietorship deduct premiums paid at her husband's W-2 job?
Yeah. Yes. The answer is yes, because your husband has a job. He's. I assume the company's paying something and he's paying out of pocket. But this is a family plan, I would assume. If it's just for his insurance and you're not covered, then but no, that doesn't work. But you've got a sole proprietorship business. Therefore, the IRS says that you can deduct, because you've got a sole proprietorship business, you can deduct whatever you and your dependents, or in your case, your husband, I assume you're filing married married filing jointly, then yes, the answer is whatever you're paying for medical premiums as a family, you can deduct out of your sole proprietorship business. I'm telling you, this is missed by so many people, and yet it's right there in the IRS code in black and white. So good question. That's exactly where I'm helping a lot of people on this, on their personal taxes, is they don't know that can be deducted.
I think a lot of CPAs and accountants miss it, maybe because they're a little afraid, like the home office deduction, they're afraid, oh, it's too aggressive. Remember, they're only as good as the information you give them.
Absolutely right. And a lot of people, think that maybe they've got an inadequate accountant, or maybe just isn't up to speed on new tax law. Most likely that's not the case, but it could be more important that you're giving them the wrong information. Look at things that, when I teach, I always joke with our students about purses. My wife doesn't own a single purse. She owns a lot of computer bags, because computer bags are tax deductible. So how you see the expense determines whether it's deductible and what line the IRS is going to, or your CPA is going to put that little deduction. Is it deductible? Well, it depends on how you saw the expense. Now, don't push it too far. I love America. I love the history of America. I love the founding fathers. I'm proud that we have servicemen and servicewomen that protect the America's rights. I'm proud to vote. I love America. I love being able to drive from state to state to state without borders, and on a freeway system that, for the most part, doesn't beat up my car. I appreciate that. I like driving under a bridge, or on top of a bridge, and with full confidence that it's not going to collapse on me. I like those. I like seeing kids come out of school and knowing that they're getting a good education. I like that. So pay your fair taxes, but if the IRS says you can deduct it, be aware of the free roads and the toll roads that are out there, and know that the IRS is never, ever, ever going to advertise the free roads. They're never going to put big blinking signs saying, here, come do this. So those you have to take we appreciate you being on and being concerned, but it becomes our responsibility, not our accountants. That's probably the biggest mistake I see people make on taxes, is relying on their accountant to just take what little pieces of information and assume that they can save you money on taxes, when you really didn't do your homework and didn't give them good information. So encourage you to do that. Anything else, Kendall?
Yeah, Dan is asking about converting from a traditional to a Roth, that you covered a little bit already. Mm-hmm. And there's a good reason why we're doing that right now. Why?
Yeah, in essence, those of you that maybe don't understand, a traditional, you get a tax deduction. Let's say I'm putting in $6,000 or $7,000 because I have gray hair and I'm over 50. So I put in my $7,000. I get a tax deduction. I don't have to pay the taxes on that. And for a really, really slow-moving growth kind of thing, that may be fine, because I'm in my early 60s, and that may... it may not be worth paying the tax. I'll pay the taxes later. But a Roth is different. The Roth, I'm going to pay the taxes. On that $7,000 contribution that I make this year, I'm going to pay the taxes on it. And what you're doing there is you're paying taxes on the seed and not on the harvest. And so on things that are highly appreciated, let's say I'm flipping houses in my self-directed IRA, or I've doing Mike Koval stuff, and I'm getting 30-40% return on my investments, or I don't know, whatever I'm getting. I'm an aggressive stock market trader, or I've got a really good fund that's paying 12-14%. Okay, that's good. That's going to grow, and I would rather pay tax. I'd rather have you, our student, pay taxes on the seed and not on the harvest. So we look at the life expectancy of this IRA. When am I really going to need it? In 2 years? What are the tax rates going to be in 2 years? I don't know. We look at those things and we say, would I rather pay the taxes on the seed or would I rather pay taxes on the harvest? And my son today set up his TD Ameritrade account, Roth IRA, and he put $2,000 in to save. And so he thought that it would be a tax deduction and he wouldn't have. And I kind of convinced him, look, you're 22 years old. Let's pay the taxes on it now. Let's not. Now that's different when I'm 40 years older than him. I have a decision to make. I may not want to pay that. I might want the tax deduction right now. But for him, when he's 22 years old and he has lots of time to invest and to see growth, I would much rather him be in a Roth IRA. I hope that makes sense and answered your question.
It's a great question.
Yep, it is. Very, very good. Thank you.
Especially right now.
Anything else?
That's it. No, that's most of the questions. Saying thanks, Don. That helps a lot. So.
Well, I hope it does, and so we wish you the very, very best. Tax season is remember May 17th. It's a Monday. If you haven't filed by then, at least you can file an extension. If you need to go back and amend and file a 1040X, it's not that difficult to do that. Just claim the deductions you missed. Scott Estell has a really good tax package. If you haven't ever taken advantage of that, oh my gosh, I encourage you to look into that. That's a really good insight that he has hours and hours of tax tips from the former senior trial attorney from the IRS. Has a great program, but short of that, there's some great opportunities out there. For instance, we're coming up to August real soon here. H&R Block always has free tax. Almost every office has, or every city has free tax training. Encourage you to take that. It's going to be tougher than most college classes that I've ever taken, but it's really good tax information. And when I took this a few years ago, the last time, if you scored a 98 on the test, they would offer you a job. I didn't want their job. And I really didn't want them to do my taxes. I really wanted to learn taxes. And they were the best gig in town on really good fundamental tax training. And so it was free. Oh, they charged for textbooks, but they showed you how to deduct it out of your business. Get the tax training that you need. Reduce your taxes. Do everything that you can. Love America. Be a patriot. Be true. But you also have an obligation to yourself, to your family, to your retirement, and save whatever you can. We believe in that. So with that, we hope you have a very, very, very good week. We've got a 3-day summit coming up very shortly, and I think we're 4 weeks away, June 14th through the 16th. That's a Monday, Tuesday, Wednesday class, and hopefully we'll see a lot of you there. Thank you for your time. We appreciate it. Hopefully this has been helpful. Have a great day.